Welcome to Fundamentals of Finance and Economics for Business. This comprehensive video is designed for aspiring business professionals, entrepreneurs, and anyone looking to gain a solid understanding of the core principles that drive financial markets and economic decisions. By the end of this video, you'll be equipped with the foundational knowledge to make informed business decisions, analyze financial data, and understand the broader economic landscape. In today's dynamic business world, a strong grasp of finance and economics is not just an advantage, it's a necessity. Whether you're managing a budget, evaluating an investment, or strategizing for growth, these fundamentals are your guiding light. We'll start by exploring basic economic principles, then delve into the essentials of financial statements, understand the crucial concept of the time value of money, learn about investment appraisal techniques, analyze risk and return, and finally, touch upon key macroeconomic factors. At the heart of all economic activity lies a few fundamental principles. These principles help us understand how individuals, businesses, and governments make decisions when faced with limited resources. Think of them as the universal laws governing how we allocate what we have to get what we want. Understanding these will unlock a new perspective on every business decision you make. The most foundational concept in economics is supply and demand. Supply refers to how much of a product or service is available, while demand refers to how much consumers want that product or service. The interaction between these two forces determines the market price and quantity of goods and services. When supply equals demand, we reach market equilibrium, a state where the market is stable and there are no forces pushing prices up or down. Scarcity is the fundamental economic problem of having seemingly unlimited human wants and needs in a world of limited resources. Because resources are scarce, we must make choices. Every choice involves a trade-off, meaning that when you choose one thing, you give up the opportunity to have something else. This concept forces businesses to prioritize and optimize their resource allocation. Now, let's shift our focus to finance, starting with financial statements. These are formal records of the financial activities and position of a business, providing a snapshot of its health and performance over a period. They are like a company's report card, essential for investors, creditors, and management to make informed decisions. The income statement, also known as the profit and loss (P&L) statement, shows a company's revenues, expenses, and net income over a period of time, typically a quarter or a year. It essentially tells you whether the company made a profit or a loss during that period. It starts with revenue, subtracts costs of goods sold, then operating expenses, and finally taxes to arrive at the net profit. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It follows the fundamental accounting equation: assets equals liabilities plus equity. Assets are what the company owns, liabilities are what it owes, and equity is the residual value belonging to the owners. This statement is crucial for understanding a company's financial structure and solvency. The cash flow statement reports the cash generated and used by a company during a specific period. It's broken down into three main categories: operating, investing, and financing activities. Unlike the income statement, which can be affected by non-cash items, the cash flow statement focuses purely on the movement of cash, making it a critical indicator of a company's liquidity and solvency. One of the most fundamental concepts in finance is the time value of money, or TVM. This principle states that a sum of money is worth more now than the same sum will be at a future date due to its potential earning capacity. In essence, money now can be invested and grow over time, making it more valuable than the same amount in the future. TVM is applied through two core concepts: present value, PV, and future value, FV. Present value is the current worth of a future sum of money or stream of cash flows, given a specified rate of return. Future value is the value of a current asset at a future date, based on an assumed growth rate. Understanding these helps in comparing investment opportunities and making sound financial decisions. To calculate present value, we use discounting, which involves reducing future cash flows to their present worth. To calculate future value, we use compounding, which involves earning interest on both the initial principal and the accumulated interest from previous periods. These two processes are central to evaluating investments and financial planning. Investment appraisal refers to the process of evaluating the attractiveness of a proposed investment. For businesses, this means deciding which projects or assets to invest in to maximize shareholder wealth. There are several techniques used to assess these opportunities, each with its own advantages and disadvantages. Two widely used methods for investment appraisal are net present value, NPV, and internal rate of return, IRR. NPV calculates the present value of all cash inflows and outflows associated with a project. A positive NPV indicates a profitable investment. IRR is the discount rate that makes the NPV of all cash flows from a particular project equal to 0. It represents the effective rate of return an investment is expected to yield. The payback period is the amount of time it takes for an investment to generate enough cash flow to recover its initial cost. While it's a simple method and often used for quick decisions, it has limitations, as it doesn't consider the time value of money or cash flows received after the payback period. It's best used as a preliminary screening tool. In finance, risk and return are inextricably linked. Return is the gain or loss on an investment over a specified period, while risk is the uncertainty of that return. Generally, higher potential returns come with higher levels of risk. Understanding this trade-off is crucial for making informed investment decisions and managing a portfolio. There are various types of risk, including market risk, credit risk, interest rate risk, and operational risk. Investors must decide how much risk they are willing to take to achieve a desired return. The risk-return trade-off is a fundamental principle that guides investment strategies. To get higher returns, one typically has to accept higher risk. Diversification is a strategy designed to minimize risk by investing in a variety of assets. The idea is that if one asset performs poorly, others may perform well, thus offsetting the losses. By spreading investments across different asset classes, industries, and geographies, investors can reduce overall portfolio risk without necessarily sacrificing returns. Finally, let's look at macroeconomic factors. These are large-scale economic forces that affect an entire economy or financial market, rather than just specific companies. Understanding them is crucial because they influence business decisions, consumer behavior, and overall market performance. Gross domestic product, GDP, is the total monetary or market value of all the finished goods and services produced within a country's borders in a specific time period. It's the broadest measure of economic activity and a key indicator of economic health and growth. Understanding GDP helps businesses anticipate economic cycles and adjust their strategies accordingly. In summary, we've covered the basic economic principles of supply and demand, scarcity and choice, the core financial statements, income statement, balance sheet, and cash flow statement. The crucial concept of the time value of money, including present and future value, and the techniques of discounting and compounding. We also explored investment appraisal methods like NPV, IRR, and payback period, the relationship between risk and return, the benefits of diversification, and the impact of macroeconomic factors such as inflation, interest rates, and GDP. Mastering these fundamentals will empower you to navigate the complexities of the business world with confidence and make strategic decisions that drive success. Thank you for watching.